A single reporting mistake could now cost you up to $10,000. And most people with foreign bank accounts have no idea they're even at risk. If you're living in the United States and you or your family still maintain savings, investments, or any type of financial account overseas, the rules just changed in a way that could directly affect you. This isn't only about wealthy individuals hiding money abroad. It applies to ordinary immigrants, retirees, students, and families who simply kept an account in their home country for convenience, security, or emotional reasons. The IRS has tightened its enforcement and clarified penalties in a way that makes even small inactive accounts potentially trigger serious consequences if they're not reported correctly. And the most alarming part is that many people who are fully honest and tax compliant still fall into violation simply because they didn't realize the reporting requirement existed. Today, you're going to understand exactly what changed, who is affected, and what steps you can take right now to avoid a penalty that can quietly build in the background until it suddenly becomes very real. Hi, I'm Sophia, and I break down complex immigration and financial compliance updates so you can stay informed, protected, and fully compliant with U.S. laws without feeling overwhelmed. If you've worked hard to build your life in the United States, followed the rules, paid your taxes, and tried your best to do everything the right way, the last thing you expect is to face a penalty over an account you barely even think about anymore. Maybe it's a small savings account your parents opened years ago. Maybe it's an inherited investment you never actively manage. Or maybe it's simply a backup account in your home country that gives you peace of mind. What many people don't realize is that U.S. tax and financial reporting laws don't look at how often you use an account or whether it feels important to you. They look at whether the account exists, whether you have control over it, and whether its balance crosses certain thresholds at any point during the year. That's why understanding these new clarifications and enforcement priorities is not just helpful, it's essential if you want to avoid unnecessary stress, unexpected penalties, and complicated compliance issues later on. What makes this update so important right now is that the IRS is no longer treating foreign account reporting as a niche issue that only affects a small group of high net worth individuals. Instead, enforcement is being applied more broadly with clearer expectations and stricter consequences for anyone who falls under the reporting requirements, even unintentionally. This shift matters because many people living in the United States still maintain financial ties to their home countries for completely normal reasons. They may have a retirement account they contributed to before immigrating, a family up-supported account used during their student years, or a joint account that helps them support relatives abroad. In their minds, these accounts feel distant and unrelated to their current U.S. tax life. So they never imagine that simply not reporting them could be seen as non-compliance. The reality, however, is that U.S. tax law focuses on global financial visibility. If you are considered a U.S. taxpayer, whether as a citizen, green card holder, or certain long-term residents, the government expects transparency about financial accounts you control outside the country, regardless of whether those accounts generate income or remain largely untouched. This broader enforcement environment is exactly why so many otherwise honest taxpayers are suddenly discovering that something they ignored for years now carries real financial risk. To understand how this works, you first need to clearly grasp the core reporting rule that sits at the center of all of this. The requirement to file what is commonly known as an FBAR or report of foreign bank and financial accounts. This is not a traditional tax form that goes with your annual return. Instead, it is a separate electronic report filed with the Financial Crimes Enforcement Network, and it applies if the total value of all your foreign financial accounts combined exceeds $10,000 at any point during the calendar year. The key phrase here is at any point. That means even if the balance only briefly crossed that threshold for a single day, the reporting requirement can still be triggered. Another common misunderstanding is thinking that each account is evaluated separately, but the rule actually looks at the aggregate balance of all qualifying foreign accounts. So if you have two accounts overseas with $5,000 each, the combined value pushes you over the threshold, even though neither account individually seems significant. It also doesn't matter whether the account is a checking account, savings account, brokerage account, mutual fund, or another financial account held abroad. If you have a financial interest in it or signature authority over it, the law generally expects it to be reported once those thresholds are met. Now, alongside the FBAR requirement, there is another layer of reporting that often causes even more confusion, and that is Form 8938, which is filed directly with your annual tax return. While FBAR focuses on foreign financial accounts and is submitted separately, Form 8938 is part of your federal income tax filing and is designed to disclose specified foreign financial assets when they exceed certain thresholds. These thresholds vary depending on your filing status and whether you live inside or outside the United States, which is why many taxpayers mistakenly assume they don't need to worry about it. For example, a single filer living in the U.S. may need to file Form 8938 if their foreign financial assets exceed $50,000 at the end of the year or $75,000 at any time during the year. While the limits are higher for married couples filing jointly, the critical point is that FBAR and Form 8938 are not interchangeable. Filing one does not automatically satisfy the requirement for the other. Many people unknowingly file their tax return without Form 8938, believing their obligations are complete while separately overlooking the FBAR filing requirement altogether. This layered structure is precisely what creates compliance gaps. Not because people intend to hide anything, but because the system itself can feel fragmented and technical if you've never been clearly guided through it. What has heightened concern recently is not just the existence of these forms, but the way the IRS has clarified and reinforced the penalties tied to noncompliance. For non-willful violations, meaning situations where a person simply didn't realize they were required to file, the penalties can still reach up to $10,000 per violation, and those violations can accumulate across multiple accounts and multiple years. For willful violations where the IRS believes someone intentionally avoided reporting, the financial consequences can become dramatically more severe, potentially reaching the greater of $100,000 or 50% of the account balance per violation. Even more unsettling for many taxpayers is the understanding that these rules don't only apply going forward. If there were past years where required forms were not filed, those years can still come under scrutiny, especially as international financial data sharing has expanded. This means that a reporting oversight from several years ago, something you may have completely forgotten about, can suddenly resurface as a compliance issue today. And that realization is exactly what causes so much anxiety, because people who have always tried to follow the law suddenly recognize that a simple lack of awareness could carry consequences they never imagined. At this point, a question naturally comes up that many viewers are quietly wondering. How would the IRS even know about an account held in another country, especially if you've never transferred money in or out recently? The answer lies in the global financial transparency systems that have developed over the past decade. Many foreign financial institutions now share account information with U.S. authorities under international agreements designed to combat tax evasion and increase reporting accuracy. This means that even if you personally never mention an overseas account on your tax return, the existence of that account may still be visible through these data exchanges. You don't have to move large amounts of money or actively trade for the account to become detectable. Sometimes the mere fact that the account exists under your name or that you have signature authority over it can be enough for it to appear in cross-border reporting channels. This doesn't mean the IRS is automatically targeting honest taxpayers, but it does mean the assumption that no one will notice because I never use that account is no longer a safe assumption. The system has evolved in a way that quietly increases visibility, and that's why awareness and proactive compliance are now far more important than they were years ago. If this information is already making you rethink accounts you may have forgotten about or never considered relevant, that's actually a positive step, because the biggest risk usually comes from simply not knowing the rules exist in the first place. Staying informed about changes like these can save you from stress and unexpected penalties later on, which is exactly why updates on financial compliance and immigration-related obligations matter so much for anyone with international ties. If you find this kind of clear, practical breakdown helpful, make sure you stay connected so you don't miss future updates that could directly affect your legal and financial standing in the United States. Now, with that foundation in mind, the next crucial step is understanding who is most affected by these clarified enforcement priorities, because the group at risk is much broader than many people assume. And recognizing where you personally fall in that spectrum can help you decide what actions, if any, you should take next. The people most affected by these reporting requirements are not a small specialized group. In reality, they include a wide range of ordinary individuals whose financial lives naturally span more than one country. Green card holders who kept their original bank accounts back home, naturalized citizens who inherited investments from family abroad, retirees receiving foreign pension payments, international students whose parents deposited funds into overseas accounts for support, and small business owners who occasionally handle transactions through foreign financial institutions all fall within the scope of these rules. Even having signature authority over a joint family account can create a reporting obligation regardless of whether the money actually belongs to you. This is where many misunderstandings occur because people often associate compliance risks with high value assets or complex offshore structures, when in fact, the law focuses on access and control, not just ownership. If your name is on the account or you can direct how funds are used, that alone can be enough to trigger a requirement once the balance thresholds are met. Realizing that the rules apply to such everyday situations can feel unsettling at first, but it also helps clarify that the goal is transparency, not punishment, and that understanding your specific role in any foreign account is a critical first step towards staying fully compliant. To make this more concrete, imagine someone who moved to the United States many years ago and left behind a modest savings account in their home country, opened long before immigration was even part of their plan. Over time, life in the U.S. became the priority. Taxes were filed correctly each year, and that small account faded into the background, rarely checked and almost never used. From a personal perspective, it feels irrelevant, more like a forgotten financial memory than an active asset. But from a reporting standpoint, if the balance in that account exceeded $10,000 at any point during the year, the requirement to disclose it could still apply. The intention behind the rule is not to penalize people for maintaining ties to their home country, but to ensure that all foreign financial relationships are visible within the broader tax compliance system. This example highlights how easy it is for an honest taxpayer to unintentionally miss a filing requirement simply because the account feels emotionally or practically insignificant, even though legally it still counts. Consider another common situation involving an inherited investment account held overseas. Someone may become a U.S. citizen and later inherit a brokerage account from a parent living in another country. The account might be professionally managed with statements arriving infrequently and little day-to-day involvement from the beneficiary. Because they're not actively trading or moving funds, they may assume that the account doesn't really affect their U.S. tax obligations. However, if the value of that account crosses the applicable reporting thresholds, it can trigger both FBAR and potentially Form 8938 requirements, even if the person never withdrew a single dollar. The key issue is not activity, but existence and value. This is why passive accounts, inherited accounts, or accounts handled by advisors abroad can still create compliance obligations. Many people only discover this after attending a seminar, speaking with a tax professional, or encountering informational content like this. And they're often surprised to learn that simply overlooking a disclosure requirement, even without any intention to hide assets, can still be classified as non-compliance under the rules. What makes these situations even more complicated is that most violations are not driven by deliberate concealment, but by understandable assumptions that turn out to be incorrect. People frequently believe that if an account is small, inactive, or primarily used by family members overseas, it doesn't need to be reported. Others assume that if no income is generated, then there is nothing relevant for U.S. tax purposes. Some think that because the account was opened before they became a U.S. taxpayer, it somehow falls outside current reporting obligations. These assumptions feel logical from a personal standpoint, yet they don't align with how the reporting framework is actually structured. The law focuses on financial interest, signature authority, and value thresholds rather than intent or usage frequency. Recognizing this distinction is important because it shifts the mindset from "I did nothing wrong" to "I need to confirm whether any reporting requirement exists," which is a far more protective approach. By understanding that many compliance gaps come from simple lack of awareness, viewers can move from anxiety to clarity and begin taking practical steps that ensure they remain on the right side of the rules. With that clarity in mind, the next step is shifting from awareness to action, because knowing the rules only helps if you translate that knowledge into a simple, organized review of your own situation. The first practical step is to determine whether any foreign financial accounts you are connected to ever cross the relevant thresholds during the year, even briefly. This means looking not only at accounts you actively use, but also at older accounts, joint family accounts, inherited investments, retirement funds abroad, or any account where you have signature authority. The key is to think broadly and honestly about your global financial footprint, rather than narrowly focusing on accounts you consider important. Once you identify those accounts, the next step is to gather accurate information about them, including the name of the financial institution, account numbers, and the highest balance reached during the year. Many people worry that this process will be overly technical, but in reality, it often starts with simply collecting statements or contacting the bank to request balance summaries. Taking the time to compile this information creates a clear picture of whether filing requirements apply, and it replaces uncertainty with concrete facts, which is always the strongest defense against unexpected compliance issues. After gathering that information, the next consideration is what to do if you realize that reporting should have occurred in prior years but didn't. This is where many viewers feel a surge of anxiety, imagining immediate penalties or enforcement actions. But it's important to understand that the system does provide pathways for taxpayers who come forward voluntarily and correct past omissions in good faith. Addressing the issue proactively before any official notice is received often allows individuals to resolve non-willful mistakes under more manageable conditions than if the oversight were discovered later through external reporting channels. The essential point is timing and intent. Acting early demonstrates a commitment to compliance and reduces the likelihood of the situation escalating into something far more serious. Instead of viewing past missed filings as a permanent problem, it's more helpful to see them as a correctable gap, one that can be addressed with accurate information, proper forms, and when necessary, professional guidance that ensures everything is handled correctly moving forward. If you do discover that required forms were missed in previous years, the most important thing is not to panic, but to act thoughtfully and promptly. The IRS has established procedures that allow taxpayers to come forward and correct past reporting gaps when those gaps were non-willful, meaning they occurred because of misunderstanding or lack of awareness, rather than any deliberate attempt to hide assets. Taking advantage of these options typically involves filing the missing reports for prior years, accurately disclosing the accounts, and certifying that the failure to report was unintentional. This proactive approach often places you in a far stronger position than waiting and hoping the issue never surfaces. Once a notice or inquiry is initiated externally, the range of available remedies can narrow, and the process may become more stressful and complex. By contrast, voluntary correction demonstrates cooperation and responsibility, two factors that significantly influence how these situations are handled. The overarching lesson here is that discovering a past oversight does not automatically mean facing the harshest penalties. In many cases, it simply means taking organized steps to bring your records into alignment with current requirements. As you move forward, it also becomes essential to build habits that make future compliance easier and less intimidating. Maintaining organized records of all foreign accounts, including annual maximum balances, statements, and any correspondence from financial institutions, can make each year's reporting process far more straightforward. Keeping copies of submitted forms and related documentation ensures that if questions ever arise, you have clear evidence of what was reported and when. This kind of record keeping is not about expecting an audit or assuming something will go wrong. It's about creating a reliable paper trail that gives you confidence and control over your own financial narrative. When documentation is organized and accessible, even complex international reporting requirements start to feel manageable rather than overwhelming. Over time, this simple discipline transforms compliance from a source of anxiety into a routine administrative task, reducing the risk of last-minute confusion or forgotten obligations that could otherwise lead to avoidable complications. There are also situations where seeking professional guidance becomes especially valuable, not because you've done anything wrong, but because international financial reporting can involve nuances that aren't always obvious from general guidance alone. For example, individuals with multiple foreign accounts across different countries, interests in foreign retirement plans, involvement in family businesses abroad, or access to joint accounts that they do not personally fund may face reporting scenarios that require careful interpretation. A qualified tax professional who understands international compliance can help confirm which forms apply, ensure calculations are accurate, and identify any additional disclosures that may be necessary. This kind of review can provide peace of mind, especially when your financial life spans more than one jurisdiction and the rules in each place operate differently. Rather than viewing professional advice as something only needed during a problem, it can be more helpful to see it as a preventive step that strengthens your overall compliance strategy and reduces the likelihood of unexpected issues later. To illustrate how easily these obligations can arise, think about the case of someone who immigrated to the United States and left behind a fixed deposit account in their home country that their parents helped establish years earlier. The account might sit quietly, earning modest interest, rarely discussed, and almost never accessed. Yet its balance could still exceed the reporting threshold during certain periods of the year. From a personal standpoint, the account may feel like a distant financial relic rather than an active part of daily life in the U.S., so it never crosses the person's mind during tax season. Only later, perhaps through a community seminar or formational update, do they realize that the mere existence of that account created a reporting obligation all along. The realization can be startling, but it also becomes an opportunity to correct course, gather the necessary information, and file the appropriate disclosures moving forward. Stories like this highlight how common and understandable these oversights are, and why staying informed is one of the most effective ways to protect yourself from avoidable penalties while maintaining full compliance with evolving reporting expectations. Stepping back for a moment, it helps to understand the broader reason these rules have been tightened and clarified in recent years. Governments around the world have been working together more closely to reduce tax evasion and improve financial transparency across borders, which has led to expanded data sharing agreements between countries and stricter reporting expectations for taxpayers with international financial ties. From a policy perspective, the objective is not to punish ordinary people who maintain legitimate accounts abroad, but to ensure that all global income and assets connected to U.S. taxpayers are visible within the system. However, when enforcement becomes more robust and automated, the practical effect is that even small unintentional omissions are more likely to be detected than they were in the past. This shift means that relying on outdated assumptions about privacy or invisibility of foreign accounts is no longer a safe strategy. Instead, the modern approach to compliance is based on proactive disclosure and clear documentation, recognizing that transparency is now built into the global financial infrastructure rather than being an optional extra layer of reporting. When you distill everything we've discussed so far into a few essential takeaways, 3 core ideas stand out as especially important for protecting yourself going forward. First, understand that foreign account reporting requirements are triggered by thresholds and control, not by how often you use the account or how important it feels in your day-to-day life. Second, recognize that missing a filing requirement is often a correctable issue, particularly when addressed voluntarily and in good faith before any official inquiry begins. And third, make it a habit to review your global financial connections each year, even briefly, so that nothing is forgotten or overlooked as your circumstances evolve over time. These principles shift the focus from fear of penalties to confident, informed compliance, allowing you to stay aligned with the rules without feeling constantly worried about hidden risks lurking in the background. At the end of the day, the purpose of understanding these rules is not to create fear, but to give you clarity and control over a part of your financial life that often goes unnoticed until it suddenly becomes important. Most people who find themselves at risk of penalties are not trying to hide anything or avoid their responsibilities. They are simply navigating life across borders, maintaining ties to their home countries, and doing their best to follow complex rules that were never clearly explained to them. By staying informed, reviewing your accounts honestly, and taking timely action when needed, you place yourself in a strong position to remain fully compliant without unnecessary stress. Instead of worrying about what might happen in the future, you can move forward with the confidence that comes from knowing you've taken the right steps to protect your financial stability and legal standing in the United States. Awareness, organization, and proactive action together form the most reliable safeguard against surprises, and they allow you to focus on building your life and future rather than looking back at overlooked obligations. Before we close, it's important to remember that everything discussed here is intended for general formational purposes to help you understand how foreign account reporting rules and related penalties may apply in common situations. Individual financial and immigration circumstances can vary significantly, and even small differences in account structure, ownership, or residency status can affect your specific obligations. That's why it's always wise to verify details through official government resources, and when necessary, consult a qualified tax professional who can evaluate your unique situation and provide tailored guidance. Staying informed, asking the right questions, and seeking accurate advice when needed are the best ways to ensure long-term compliance and peace of mind. Thank you for spending this time with me and taking a proactive step toward protecting your financial future.